In November 2024, Donald Trump was assembling his cabinet. The most coveted economic position in the U.S. government, Secretary of the Treasury, was up for grabs, and a familiar face was at the very top of the shortlist: billionaire investor John Paulson. Before the nomination could even be formalized, Paulson abruptly pulled his name from consideration. He released a brief statement, citing what he called complex financial obligations that prevented him from taking the job. To understand how shocking this retreat is, you have to look at his resume. 16 years earlier, Paulson executed the most profitable single trade in Wall Street history. He walked away with $15 billion for his firm by shorting the subprime mortgage market right before the 2008 crash. His strategy worked because he spotted a fatal structural flaw in the housing sector, a massive blind spot that banking titans completely ignored right up until the moment they collapsed. What specific tangled web of modern wealth is so complex that it forced the architect of the greatest trade in history to surrender the ultimate seat of economic power? The answer starts in 2020. That's when Paulson closed his traditional hedge fund to outside investors and converted it into a private family office. Without external clients or quarterly reporting demands, he had absolute freedom to allocate his capital however he wanted. This chart shows how he used that freedom to build a barbell portfolio. Abandoning standard diversification, Paulson embraced portfolio minimalism. He placed massive, highly concentrated bets on two extreme ends of the market, leaving almost nothing in the middle. On one end sits a staggering 35.7% allocation in a single biotechnology firm, Madrigal Pharmaceuticals. This is an incredibly illiquid position, tying up a massive percentage of his net worth in the volatile, event-driven outcomes of drug approvals. On the other end of the barbell, he stacked heavy investments in gold mining operations, snapping up huge stakes in companies like Perpetua and NovaGold. These mining plays are driven by his specific macroeconomic forecast. Paulson expects global inflation and escalating trade tensions to push the price of physical gold toward $5,000 an ounce. If you're nominated for Treasury Secretary, federal ethics laws require you to divest from assets that pose a conflict of interest. Liquidating these hyper-concentrated positions quickly would wreck his long-term investment strategy, trigger massive personal tax penalties, and severely disrupt the open market. Paulson's public market holdings sit alongside a massive private portfolio. He has acquired a sprawling network of luxury hotels and high-end real estate, anchored entirely in the physical landscape of Puerto Rico. He has publicly stated his ambition to transform the island into the Singapore of the Caribbean, backing that vision with over $1 billion in ongoing property developments. Looking at this comparison chart, you can see the sheer economic weight of his operations. Paulson's investments in properties currently generate an economic impact equivalent to roughly 3.5% of Puerto Rico's entire gross domestic product. Liquidating publicly traded stock is a simple transaction. Divesting from an entire territory's economic infrastructure is an agonizing multi-year process. His footprint is simply too large to untangle. Then there is the final and perhaps most chaotic barrier keeping him out of Washington: his ongoing high-profile divorce from his wife of 21 years. Because they were married long before he made his billions, the couple never signed a prenuptial agreement. That exposes the entirety of his accumulated fortune to legal division. The legal battle has escalated into intense warfare over private family trusts, with billions of dollars heavily contested and effectively frozen in court. The situation is further complicated by intense tabloid scrutiny. Paulson is now engaged to a 35-year-old influencer, and the couple is expecting a child, adding another layer of tension to an explosive settlement negotiation. Even if Paulson wanted to fire sale his stock portfolio and liquidate his Puerto Rican monopoly for a cabinet seat, he can't. The divorce litigation means his wealth is legally immobilized. When Paulson cited complex financial obligations, he was describing an escapable gridlock. He is wedged between a hyper-concentrated stock portfolio, a sovereign-scale territorial monopoly, and a frozen multi-billion-dollar divorce. Subjecting that tightly wound financial web to the hostile, microscopic scrutiny of a Senate confirmation hearing was a functional impossibility. It's a sharp contrast to the defining achievement of his life: In 2008, he amassed a historic fortune, specifically by identifying a structural trap that everyone else was completely blind to. By using the absolute freedom of a private family office to build an intensely concentrated empire, Paulson inadvertently built an inescapable structural trap of his own, one that permanently locked him out of the ultimate room of power.